If I was getting a mortgage in 2026, I wouldn't be obsessing over the base rate. And it's usually the last thing to move and has little impact on actual mortgage rates you're going to get. What I'd actually be focusing on are three things that most people ignore and are far more likely to have a greater impact on what rates are available on your mortgage. So first, unemployment data. When unemployment starts to rise, it tells you the economy is slowing. And when the economy is slowing, pressure builds for interest rates to come down. Mortgage lenders price this risk in early, often well before the base rate changes. Second, inflation, but not the headline numbers. The key question is whether inflation is clearly coming down and whether things like wage growth and service inflation are easing. Mortgage rates move when inflation is expected to go, not where it has been. Third, GDP growth. You don't need a full-blown recession for mortgage rates to improve. Flat or weak growth is often enough to change expectations and push lenders to reprice fixed rates. And this is the bit that most people actually miss. Mortgage rates are driven by forecasts and market expectations. By the time the base rate actually moves, lenders have usually already priced this into their mortgages. And that's why waiting for the perfect base rate cut rarely works. If you plan to buy or remortgage in 2026, understanding the wider economy will tell you far more about where mortgage rates are heading than the base rate ever will.